Welcome to our exploration of monetary policy, an essential tool wielded by central banks to influence the economic landscape. Within macroeconomic management, monetary policy acts as a silent yet powerful force shaping interest rates and money supply, steering national economies towards stability. In this video, tailored for AP Macroeconomics students, we'll delve into why understanding monetary policy is essential. It's not just theoretical, but a critical mechanism impacting everyday life, influencing prices, employment, and economic growth. From its fundamental definition to its intricate limits, we'll uncover what makes monetary policy indispensable in economic strategy. So, let's embark on this journey, setting the stage for a comprehensive understanding of how central banks like the Federal Reserve deploy these strategies to nurture economic well-being. Join us as we unravel the layers of economic influence and strategy. Monetary policy is a pivotal economic tool, meticulously managed by central banks like the Federal Reserve to regulate the nation's money supply and interest rates. These actions are crucial in guiding the economy toward essential macroeconomic objectives, such as stable prices and sustainable growth. By adjusting the flow of money and interest rates, central banks aim to either stimulate economic growth or curb inflation. This balancing act impacts not only national economies, but also sets the tone for global financial stability. As we dive deeper, we'll uncover the complexities and tools central banks wield, providing you with a nuanced understanding of how monetary policy shapes the world around us. In the intricate dance of the economy, monetary policy takes center stage, striving to stabilize prices and maximize employment, which are vital for macroeconomic stability. Stabilizing prices involves maintaining a steady inflation rate, ensuring your money's purchasing power remains consistent. Meanwhile, maximizing employment is crucial for a robust labor market with minimal unemployment. Both goals work in tandem, guiding the economy towards sustainable growth. By achieving these objectives, central banks like the Federal Reserve create an environment where businesses thrive, consumers are confident, and the economy grows steadily. Keep these goals in mind as we explore the workings of monetary policy. They're the threads weaving our economic fabric. Let's explore the instruments central banks employ to maintain economic stability. Leading the charge is open market operations, a strategy for regulating the money supply through buying or selling government securities. Followed by the discount rate, a critical factor in setting baselines for interest rates and influencing banks' borrowing costs. Lastly, reserve requirements dictate the funds banks must hold, impacting their lending capacity. The Federal Reserve adeptly adjusts these tools to meet monetary objectives, stimulating or restraining economic activity to achieve price stability and full employment. Understanding these mechanisms is vital for grasping how monetary policy shapes our economy. In our next segment, we'll see how these tools fit into expansionary and contractionary policies. In navigating economic cycles, central banks like the Federal Reserve implement two primary types of monetary policy: expansionary and contractionary. Expansionary policy aims to boost economic growth by increasing the money supply and lowering interest rates, encouraging spending and investment, especially during downturns. Conversely, contractionary policy reduces inflation by decreasing the money supply and raising interest rates, curbing spending in an overheated economy. By carefully applying these policies, central banks maintain balance, ensuring steady economic growth while controlling prices. Understanding these types enhances our comprehension of how central banks manage economic landscapes to align with prevailing conditions. Let's explore the pivotal relationship between interest rates and aggregate demand. When central banks adjust interest rates, they send ripples through the economy. Lower rates often encourage borrowing, prompting businesses to invest more in capital, like properties and machinery, and consumers to make significant purchases, such as homes and cars. This boosts consumer spending, a crucial driver of aggregate demand. Conversely, higher rates can stymie borrowing, as loans become costly, cooling consumer spending and corporate investment. Understanding this dynamic is essential for grasping monetary policy's influence on economic activity. Interest rates are more than numbers, they're levers that shape economies, affecting countless decisions. In severe economic turmoil, traditional monetary policy tools might fall short. Here, quantitative easing, QE, comes into play. The Federal Reserve purchases long-term securities, injecting extensive money into the economy, specifically when interest rates are near zero and distress persists. This unconventional approach lowers long-term rates and supplies banks with additional capital, encouraging lending and investment. QE was crucial during the 2008 financial crisis, stabilizing financial markets and stimulating growth. While impactful immediately, QE isn't without critics and potential long-term impacts. Understanding these aspects offers insight into how central banks maneuver during critical periods. Despite its many tools, monetary policy isn't all-encompassing. Time lags pose a challenge, as the effects of policy changes may take months or years to influence the economy fully, complicating swift responses to shifts. Additionally, liquidity traps occur when interest rates are near zero, diminishing the effectiveness of traditional monetary policy as borrowing and spending fall, despite low rates. These limitations highlight the intricate nature of economic management and affirm that monetary policy, though crucial, must be paired with other measures for optimal stability. Understanding these constraints provides valuable insight into policymaking's delicate balance. Throughout our journey, we've uncovered the intricate world of monetary policy, central to guiding economic stability and growth. From its definition to exploring goals, tools, and types, we've shown how pivotal policies influence aggregate demand. Amid challenges like time lags and liquidity traps, we acknowledge these strategies' boundaries. Yet understanding these elements empowers us with insights into macroeconomic complexities. As we conclude, remember, this is only a fragment of the monetary policy dialogue. Education is ongoing, and there's always more to discover. Join us, stay informed with AP Television, and let's delve into macroeconomics' fascinating narratives. Until next time, keep learning and questioning.